Okay, we might make a start. Hello, everyone. My name is John Basilius. I'm a partner here at Holley & Wilcox and a director of Blockchain Australia. On behalf of Holley & Wilcox and Blockchain Australia, I would like to welcome you all for coming in today and welcome everyone who's joined us online. I'll start off by acknowledging all of the traditional custodians of country throughout Australia, where we each meet from today, and recognise their continuing connection to the land, waters and community. I'm on the land of the Gallagher people of the Eora Nation, and I pay my respects to the elders, both past, present and emerging, and also to all Aboriginal and Torres Strait Island people joining us today. I would like to welcome Evan Gallagher and Tess Ogle from AUSTRAC, who'll be talking to us about all things AML-CTF. Thank you.
Thank you, and it's great to be here today to have a chance to talk to you. My name is Evan Gallagher. I'm in the policy area at AUSTRAC, and my particular interest in digital currencies and virtual assets is that I'm on the Virtual Assets Contact Group at the Financial Action Task Force, so I participate in those discussions. I guess I should say I'm going to talk about the international developments that are affecting virtual assets and digital currencies, what's coming down the line potentially, and Tess will talk more about the domestic situation at the moment. So probably most of you are familiar with the Financial Action Task Force and what it is. It's the global standard setting body for anti-money laundering and counterterrorism financing regulations and broader efforts to combat money laundering and terrorism financing. It sets standards called the FATF recommendations, which are not binding on, directly binding on businesses. That's important to remember. It's actually guidance for countries in how they frame their anti-money laundering legislation. So when I talk today about the changes of the FATF, it's not that this is directly binding on businesses, but it is something to look out for in terms of where countries are going to go in amending their own legislation on anti-money laundering issues. They tend to have carry a lot of weight though, because countries are publicly assessed against these standards, and those findings are published on the FATF website and are quite persuasive. So in 2019, the FATF changed its standards to require regulation of digital currency exchanges, or as it's known internationally, virtual asset service providers. Along with that, they established a Virtual Assets Contact Group, which I participate in to maintain a sort of a watching brief on the issues as they emerge, given it's such a fast-moving area, and also developed guidance and set up a 12-month review process to look at whether any further changes to the standards were required. We're actually in the second 12-month review process now, where there's consultation currently on updates to the FATF guidance. That is currently publicly open for public comment until tomorrow, and it's sort of very important, I think, in this sector in particular, to get private sector input to help us understand the issues. In Australia's case, we were quite an early mover on an anti-money laundering regulation. We moved to regulate the exchange of digital currency for fiat currency and vice versa in 2018. The new FATF standards came in 2019 and extended to some other activities that should be regulated. So that includes virtual asset to virtual asset exchange, transfer of virtual assets on behalf of other people. So that's almost like remittance of virtual assets. Safekeeping and administration of virtual assets, such as custodial wallets, and participation in and provision of financial services related to an issuer's offer and or sale of a virtual asset, which is, I think the most common example would be an ICO. So there's a range of additional activities that at the international level under the standards fall within the scope of anti-money laundering regulation and what countries are expected to regulate. We aren't there yet. We regulate only the first activity, the exchange of digital currency for fiat currency, but some of those other activities can involve that incidentally, which is something important to note. The first 12-month review by the FATF was completed in June last year, and that found that there was no need to update the standards at that time. But there was a continued focus on a few issues, which I'll address. So-called stable coins, as the FATF calls them, and particularly the regulation of centralized governance bodies in those ecosystems and what their anti-money laundering regulations are. implementation of the travel rule and the issue of risks around peer-to-peer transfers. Those are transfers between, I guess, self-hosted wallets. The travel rule is probably, I think, the most, well, I guess it was the most ambitious part of the new FATF standards. It essentially requires that countries should legislate to require the simultaneous and secure transmission of information about the payer and the payee of any transfers of virtual assets between VASPs or digital currency exchanges. And also that information should be obtained and held in all cases by digital currency exchanges. It's important to note that it's only necessary to verify the payer's information because they're going to be the customer of the digital currency exchange, whereas the payee is not always going to be a customer of the exchange, and therefore that does not need to be verified, that information, but it needs to be obtained and transmitted securely. The reason, I guess the question might come up, why would the FATF require this? Well, it's kind of equivalent to some requirements that have been around for traditional financial, the traditional financial sector for a number of years, where wire transfers and the equivalent are required to have payer and payee information accompany them. The reasons for it are that it helps VASPs to fulfill their legal obligations in terms of managing AML-CTF risk or MLTF risk, and to fulfill sanctions obligations, for example, where you need to know both parties to a transaction to do sanctions screening in many cases. It also enables information to be provided to appropriate authorities on request, and that information will be in the jurisdiction where the VASP is located, without having to necessarily go through complicated processes to obtain information from overseas. And it, as I said, it mirrors the requirements for financial institutions. Some of the challenges, though, that are recognised at the international level are quite important to take account of. So the sunrise issue, as it's called, is one of the big ones for the travel rule. Countries will move at different rates and different speeds to implement the new standards, and it may be that other countries will move before Australia to require this in legislation. In fact, some countries already do. And so that's, I guess, if there's one message I'd like to give today, is to start thinking about this now, because even if Australia's legislative timetable is yet to be determined, other countries may, if you're dealing with virtual asset service providers or DCE's counterparts in other countries, they may become subject to the travel rule earlier and may start asking for information. One of the other challenges around the travel rule is the availability of technical solutions to allow this to happen. So the simultaneous and secure transmission of information. That's the FATF standards have driven the development of a number of products in the private sector. Regulators aren't going to pick winners amongst those products, but there are a number of them out there. Some of them, from what I've heard, are live. But I won't speak to any of them in particular. The other issue is that there's the development of international standards, or sorry, industry standards around what the travel rule messages should contain to ensure interoperability between different travel rule solutions. And I'd like to acknowledge the work of Blockchain Australia through IDAXA in contributing to some of that work. Some other challenges around establishing credentials as a regulated VASP, because the requirement is that the information flow between regulated virtual asset service providers. And how do you do that? It seems most countries publish their register, their equivalent of the DCE register. In Australia, that's not published right now. So that may be something that we need to think about going, as the travel rule starts to be implemented. And of course, the issue of privacy and data protection comes up. But that's not really unique to the sector, the VASP sector globally, but it is one that I know that many are thinking about internationally. Very quickly then on peer-to-peer transfers, they're not subject to FATF standards directly, but the guidance that's being developed now is looking at some of the risks associated with them and potential responses from the countries could put in place, but it's not prescriptive standards at the moment. It's really just an issue of concern to a number of delegations. On stablecoins, The FATF is clear that they must be regulated for AML/CTF purposes, and how that happens is up to countries. In Australia's case, I think it's pretty clear that stablecoins qualify as a digital currency under our legislation, but other countries may have different legal frameworks that regulate them as other types of financial products. At the moment, the focus at the international level is on better understanding the centralized stablecoin ecosystems and the roles of the various players in those ecosystems and how AML/CTF regulation could and should be applied to them. And finally, on a few emerging issues, which you've no doubt seen if you've read the press around the FATF standards, I think there's been a lot of interest in decentralized finance and how the guidance, the draft updated guidance refers to that, and non-fungible tokens as well. I think it's fair to say that those issues are ones where there's perhaps a little bit more work to be done by regulators globally to understand the AML/CTF aspects of those products and how they can be best addressed. That might, I'm sure, come up in the discussion afterwards. But it's an area I think of growing of interest and one where I think views from industry are quite helpful in helping us as regulators to come to terms with these new products. So I might hand over to Tess with that to give a few comments.
Good afternoon, everybody. My name is Tess Ogle. I'm the manager in regulatory supervision. My team look after the digital currency exchange sector, bullion and foreign exchange. So I'm just going to quickly touch on, in my 2 minutes, the domestic space. Thank you, Evan. We've got about 470 registered DCEs at the moment. When we put the legislation into place, we were expecting that 20 to 30. So as you can understand, that's a bit of an expansion and a lot of work for my team. So props to them as they go on. We are at the 3-year renewal period at the moment. So every 3 years, digital currency exchanges need to re-renew. It's a fairly simple process. We're working through that at the moment. I did have a couple of stats that I wanted to kind of read out and let you know that. So in terms of the threshold transaction reports, which is the $10,000 reports that must be made to AUSTRAC, from registered DCEs, we've had an increase in transactions to crypto since April 2018, with over 41 million in 2020, and an increase of, which is an increase of 224% compared to 2019. So as you can understand, the more DCEs we get on board, the more transactions that we're getting flowing through to us, which means more information, which means more intelligence, which means keeping the community safer. And on the suspicious matter transaction reports, rather, between 2018 April and 31st of December 2020, we've received 2,089 suspicious matter reports from registered DCEs, and 1,592 of those were received in 2020 during the COVID pandemic. So that's a substantial increase of intelligence that we're getting through. I do have to say, I was quite surprised to see people in this room to hear us talk about regulation. I thought I was the only person that liked speaking of it. So I'm very much looking forward to sitting on the panel and having this discussion. I am at the full time, unless Steve gives me a nod to keep talking, or should we pause? There you go, taken, no worries, thank you.
Thank you very much, Evan and Tess. Just wait until the other panelists come. Hi, everyone. My name is Hannah Glass. I'm a senior associate at King & Wood Mallesons. In a former life, I did actually work in sort of the more traditional financial services space, but have been focusing on this area for quite a while. On a personal capacity, I also sit on the National Blockchain Roadmap Steering Committee and am chair of the RegTech Working Group. But today we're not talking about RegTech. we're talking about regulation more broadly. And thank you so much, Tess and Evan, for that brilliant introduction to everything to do with AML, CTF, and how it applies in Australia, both now and going forward. But before we start, I wouldn't mind having the other panelists introduce themselves and give a bit of background as to what their connection is to this space and how they fit in with this whole regulatory environment. So Byron.
I hope so. Name is Byron Goldberg. But loud or okay? Cool. I work at a company called Luno, a cryptocurrency company. Luno was launched in 2013 in South Africa, as Mike would know. Launched in Australia in August 2020, so last year. I'm the country manager for Luno. Luno is a very simple platform to buy, store, and learn about cryptocurrency. Only have 5 assets on the platform. To make it simple, we try to stay away from the more complex cryptocurrencies. So instant buy and sell, basic exchange, and a learning platform. And yep, that's who I am.
Thanks, Byron. Paul?
Thanks. Hi, everyone. I'm Paul Derham. I'm a partner of a financial services regulatory law firm called Holley Nethercote. And we do a lot of work with the digital currency exchanges. We oversaw the drafting of the Code of Conduct for exchanges, which was designed to help exchanges build trust with regulators, banks, their own clients. We've also written legislation in other countries to help them roll out secondary market digital currency exchange type regimes. And so we do a lot of that work in that regulatory space, trying to keep people out of court and out of the hands of the regulator as best we can.
Thanks very much, Paul. So talking about getting out of the hands of the regulator, how does that work then if you're obviously working with regulated entities?
It's a good question. And obviously the big end of town are going to have the regulators looking at them more closely, no matter how good they are. Yeah. But what do you reckon? Do you reckon you say regulators, plural? There's at least half a dozen in Australia.
That is very true.
You're an expert on this as well. You know, this is our world. Do you want to give a bit of a summary?
Sure, why not? So I think when you're talking about regulators in Australia, obviously AUSTRAC is one of the key ones in the space of crypto assets, but by no means the only one. And I think the other one that everyone has front of mind is ASIC. And we heard from Jonathan Hatch earlier on today, talking about some of the initiatives that they have and some of their thinking. But even though we kind of say, you know, there's AUSTRAC and there's ASIC, those are only 2 of the regulators. And I mean, one of the main regulators that is relevant here is actually the ACCC. People don't always think about the ACCC because ultimately that's all to do with consumer conduct and competition. And surely it's a small market, so who cares about competition? Not so much the case. As soon as you're dealing with consumers, any statement that you make cannot be misleading or deceptive. Pretty simple and kind of makes sense for most people, but people don't realize that that's actually a regulatory requirement, and there is a regulator behind that. I mean, there are a couple of other regulators too that work in this space and may or may not be applicable depending on what you're actually doing. So then you go into things like APRA, which is really about prudential regulation. So banks, superannuation, insurance, and then of course the RBA. But the RBA again is another level removed from a lot of this type of this ecosystem until you're getting into the sort of thing like the previous panel, which was central bank digital currencies. But it's not just in Australia, of course, it's overseas too. FATF, of course, impacts on everything that you do with AUSTRAC, is that right? And how have you found kind of working with FATF and kind of that collaboration between Australia and more internationally in this area?
Well, I mean, the FATF plays a key role in making sure that there's consistent, to the degree possible, consistent regulation around the world, which I guess minimizes the race to the bottom in a way that could emerge if some countries moved to regulate and others didn't. It plays a key role in making sure that countries are held accountable for the extent to which they implement the best practices that set out in their standards. So it's really, I think the FATF influences everything we do. We, of course, need to take those standards, which are quite high level, and translate them into the Australian domestic context. And that's sort of my day-to-day job, with not just on virtual assets or digital currency exchange regulation, but across the board. And you know, we have been an active voice in the virtual assets contact group and in FATF discussions around the developing new standards and the new guidance. And that really requires a deep engagement with the issues to to bring credibility to those discussions and an understanding of the sector and the issues and possible approaches, because it's an area where I think regulators globally are finding our way as this sort of industry continues to evolve. So.
Yeah. So Paul, I understand you've been working on some of those sort of standards, as you mentioned. How are you seeing this evolve as the industry is changing?
Sure. So the reason why there's a code of conduct for the exchanges is because there's not a licensing regime for the exchanges. And so the biggest problem a lot of digital currency businesses have is having a good relationship with their banks. Doesn't matter how good their tech is, they don't have a bank account. They still, to a degree, need bank accounts. And so there's this gap between needing a license and being recognised with doing the right thing and at least taking steps to protect consumers that go beyond what the law requires. So if you think about the concepts at the moment, an exchange needs to be registered with AUSTRAC. And not to diminish the role of AUSTRAC at all, but an analogy is like on the roads, okay? We have a licensing regime. You have to show that you're competent to drive a car before you can get a license. But you just have to register your trailer, okay? So you don't have to show that you can hook on the trailer and drive it. You just have to register it. And so AUSTRAC has a registration process where we've got more than 400 businesses that have said, hey, hand up, we're running a DCE here. We've got a program. We haven't been to jail. And that's the first step when you regulate a market, because until then, we didn't even know who they were, right? And now AUSTRAC is helping regulate this. The law has come in and said, we just want you to tell us who your customers are, okay? So that's the first, that's like a really important step. But licensing, I think, is the next step. And that's, you've got to show competence to drive the car. And you've got to maybe get in an external auditor to make sure that someone else is checking that you've got your client's money in the bank. And so I think that's, like, we're talking about regulatory trends today. I think that that's probably where we're going to end up with a lot of these digital currency businesses, whether they're exchanges, if they're touching other people's money, I reckon licensing will be there as well as registration. You actually need them both. And so, yeah, I think we'll see that happen. And hopefully it happens before there's some cataclysmic collapse of like a lot of consumers' money being lost. And so then the government steps in. Hopefully we can avoid that and we can take logical steps towards that. And I think on Thursday this week, there's a whole lot of sessions with ASIC. I think there's Kathy Armour as well speaking. And so maybe we'll get a bit of an indication what they think. But I think in Australia, there will be a trend towards more tight regulation, despite the fact that the roots of this whole sector is to avoid traditional paths.
Yeah. So I'm going to come back to that licensing point in a moment. But Byron, as someone who obviously has to comply with this DCE regime, how have you found it from an operational perspective?
So in Australia, as Paul mentioned, it's relatively simple. For any of the other DCEs, it is quite a simple process. If we talk about the travel rule, in Australia, non-existent yet, but internationally, we've implemented it in Singapore, because in order to be licensed under the Payment Service Act in Singapore, you need to comply with the travel rule. So there it becomes a little bit more complex because there's a number of reasons. Number one is customer experience. So for those who don't know about the travel rule, essentially when you do a crypto send, you put in the Bitcoin wallet address of the person you're sending it to. If you want to add a reference, you can add a reference on an exchange. But otherwise, that's all you do. Money gets sent 3 confirmations, money's there. With the travel rule, you have to put in the person who you're sending the money to, their name, couple of details. You have to put in the exchange where they're holding the funds or where you're sending to. In that send, there's going to be a package of information that's sent not on the blockchain with a different service provider. Now, as an exchange, you have to integrate with that second service provider, and you also have to make sure that the exchange where you're sending the funds to can receive that package of information. They might not use the same service provider. They might not be able to read the message that you're sending them. Now, that's just one potential issue that exchanges can run into, besides for the fact that the customer experience isn't fantastic because you've gone from sending to anybody to sending to a specific person. Transactions might be blocked because you might enter information incorrectly, or it might be withheld from an exchange. I was explaining to Paul outside that if, for example, in Singapore, I don't know where they are with the regulations, but if the government say, unless that other exchange is 100% regulated and implemented with the travel rule, you can't send the funds out. Then what do you do? What do your customers do if they can't send to an exchange that complies? Because I think when was it, March, the update said you have to do some sort of due diligence on the other exchanges where you're sending the funds to. That becomes a problem, obviously. Another problem that you can run into is, oh, I've gone blank. Yeah?
Sure.
Does that apply to sending to?
So non-custodial wallets, which go on blockchain.info, create a wallet. At the moment, it doesn't. But in the update, if I'm not mistaken, in March, you have to now deem those as high risk. So all of a sudden, your risk policy starts to see lots of these high risk sends. And it kind of implies that you should try limit those sends. But at the same time, and I know this is talking about this, I'm going to be chatting about this tomorrow, but blockchain is built essentially, it can be used to debank or to bank the unbanked. But if you aren't allowed to send money to people that can just go on the internet and create a wallet, it means somebody has to have a passport or a driver's license or a cell phone to take photos of those documents. So there's a billion people that now get kicked out of being able to use blockchain. So anyway, back to Luno's perspective. Technically, it is challenging. It's not as easy as here's a piece of paper, comply with it, and it's done. There's a lot of work that needs to go in, and there's a lot of intricacies.
It's interesting that you say that. I've been speaking to a couple of people overseas, and they say there is no one-size-fits-all solution. As Evan, you were saying before, that interoperability between the technological solutions is actually just as, if not more important than the interoperability between potentially the legal framework. It's almost, you've got to meet the high bar. Sure.
I was just going to say too, in terms of the unhosted wallets or the self-hosted wallets, the standards is from memory, I think, the travel rule would require that you obtain and hold the information, but not transmit it, because there's no counterparty exchange. Now that's the international standards, as I say. It's not Australian law, so we're talking about international standards here that countries need to implement. I think in terms of peer-to-peer transfers or transferring to unhosted wallets, the risk-based approach to regulation, it's rare for regulators to say this must be high risk. And I think in the case of the guidance, I think it's highlighting the potential risks of those transfers. But countries may take different approaches. So some countries may, in fact, legislate to say you must treat these as high risk. But the FATF, I guess, sets the baseline, which is just to identify those risks, and it doesn't actually regulate peer-to-peer transfer. Well, it doesn't require the regulation of peer-to-peer transfers at the moment.
You raise a very interesting point there in terms of what FATF requires as opposed to what happens nationally. So, of course, Australia is one of the first places around the world to actually implement any sort of regulation for these types of entities. I mean, how have you found that kind of being a first mover has positioned us?
Well, I guess it's given us a lot of practical experience to bring to the discussions. Obviously, the sector is still relatively new. I think it's just coming up to 3 years, so that's not a huge amount of experience regulating a sector, but we do come to the discussions at the international level with that experience behind us. It does mean, of course, that when the standards changed after we implemented our legislation locally, that we I guess, were ahead of many other countries, but at the same time, it was useful just to see how the standards developed and how the guidance developed and so on, and particularly how travel rule solutions were being developed before we move ourselves to legislate on those issues. So it's positioned us quite well in terms of beginning regulation of the sector, getting that experience, but I think we need at some point to look at how we bring ourselves up, bring Australia's regulation into line with the new standards.
So Tess, you've been sitting there quite patiently. And obviously you're at the coalface of this. How do you see it all playing out? Because where you thought the current regulation might be when it was first introduced and how it's actually being applied is obviously an order of magnitude different.
You picked that I'm a talker very quickly. Yeah, it's very interesting, actually, over the 3-year period, watching it explode in terms of registrations. Like we said, that's a low threshold. From my perspective, how it's all playing out, I think the more regulation, not necessarily always a good thing, I'm saying that as a regulator, but the right amount of regulation to get the right amount of oversight to then work with those businesses to legitimize and make it more accessible to the normal people, not necessarily early adopters. And I'm saying that as I'm not an early adopter. So I'm learning about this technology as I come to supervise it. So to the point of us being one of the first to regulate the space, I think it's actually been a really good thing as well, because we've been able to work quite closely with a lot of counterparts in other countries where they can learn from, what we've done. We can also collaborate a bit more and big on information sharing, and that helps countries regulate more effectively so that we're not overly burdening the sectors. We're allowing for some evolving and also understanding and working a bit better. So it's a fine balance to kind of walk.
Yeah.
I was just going to say, one of the highlights in Australia, of course, is the way we engage with industry in developing our regulation, and the way industry engaged with us. It was a very positive and productive approach, I think, which helped us to shape the regulation and to focus on education and outreach in the early stages and get people up to speed. That isn't necessarily the case around the world in all jurisdictions, but it does, from a regulator's point of view, it's really quite helpful to have that sort of open discussion and dialogue so that we can understand the best way to approach issues without causing unintended consequences.
And that unintended consequences is a really important point. I think that cuts across all regulation, whether it's AML, CTF, whether it's looking at exchanges, whether it's looking at anything from a broader monetary policy. That flip side is frequently forgotten. I would say probably a lot of the people in the room are very grateful for the approach that has been taken in that collaboration. Byron, going back to you again, though, because obviously you've looked at this now from a number of different places. Do you think that having been compliant in Australia helped when you were looking at how to implement these sorts of systems overseas, or not particularly?
When you say compliant in Australia, you mean with AUSTRAC?
Yeah.
Australia was actually the last country that we launched in, the latest. So reversing the question, being compliant in the other countries certainly helps. But being a global company, the regulation landscape changes all the time. So I don't know who's aware of what happened in Nigeria. got a couple hours notice. That's the central bank, which basically the RBA said, hey, none of you banks can process deposits or withdrawals to these exchanges. And that pretty much killed the industry overnight. An industry where in Nigeria, 33% of people in the country either own or have held or purchased crypto, which is quite a big stat. So just bringing it back to Evan's point, really allowing businesses to be involved in this $2 trillion industry has a massive amount of impact for citizens of countries and businesses around the world. Whereas if Australia said, cool, we're going to regulate it or we're going to shut it down, all these businesses, there are thousands of people in Australia employed by exchanges, and there's lots of people that have made lots of money, and that would all be null and void. So I guess as an exchange who's very pro-regulation, because we believe that customer comes first, we are grateful that Australia has taken a laid-back approach because, yeah.
Quite an Aussie approach to take, I would say. Now that we're obviously on the topic of exchanges more broadly, Paul, what's your view on this? Because we're talking a little bit more about how this works internationally, working on those standards. You said, looking at what's happened in Australia, you've kind of taken that out to clients overseas. Is that correct? Yeah,
so we've helped write the rules to regulate exchanges overseas, and it's nice being able to start with a fresh slate. I guess in Australia, we are a signatory to a whole lot of treaties, and we need to do, we need to take steps to comply with those treaties. And so I think, 2006, Australia entered into the world of AML CTF legislation, and since then it's slowly widened. And so I guess trend-wise, I think that will just continue to widen. Like even the definition of a VASP, a virtual asset service provider, the recommendations are to widen those definitions to include DeFi type services and various types of wallets. And so I think I think in Australia, it's just regulation is going to increase. I think we've got a bit of a Wild West going on with some people making a lot of money because of a lack of registration or a lack of regulation. There is registration. But yeah, we've got to find this trade-off in Australia, like in other countries, between what Tess was saying, between innovation and appropriate constraints.
So bringing it back to that whole idea of it being unregulated, obviously what I was mentioning before about ACCC, that's one part of it. But ASIC does set out requirements for anything that is a financial product. And I know people who went through the whole ICO sort of boom-bust cycle were certainly burnt by it. But what you're talking about is actually almost the next level of that, because ASIC regulates markets, don't they?
Yeah. And so we've seen one trend we've seen internationally is in Canada. I think they're now saying if your digital currency exchange operates in a certain way, you don't need to get a license. But actually, if you do margin lending, or if you start offering these extra products, or if you offer custody in a certain way, then we are going to require you to get a license. And so we're starting to see it. We're starting to see that trend. And in my experience, a lot of our practice is dealing with regulators, and internationally, regulators don't like it when people leave your country because it's easier to do business in another country, or vice versa. Regulatory arbitrage is something that regulators try and avoid. And so if everyone just implemented the FATF recommendations, or if everyone just did what IOSCO, which is the International sort of Securities Commission's body, recommended, then we wouldn't have customers jumping from one country to the next to get the easiest way to buy coins or something like that. So I think in addition to what we're talking about, there's going to continue to be a trend of, if you start to see more regulation come in a number of countries, it'll keep coming.
It's interesting that you mentioned IOSCO, because IOSCO actually first has been looking at this for quite a while, and brought out a paper, I believe it was in 2019, looking at the PFMI, or the Principles of Financial Market Infrastructure, and how that might apply in the crypto industry, and effectively said, if you're operating an exchange, we already have principles for other exchanges. Maybe you should have a look at those and apply them in this environment too, if you want to be a good actor.
Yeah, so every single financial markets player, whether it's a market, whether it's a bank, whether it's a custodian, whether it's a broker, there is an equivalent in the digital sector. And so it's like saying there's this new technology out here, just to keep running with this terrible car analogy, and the cars get from A to B way faster, and you don't need a license, and there is collateral damage in terms of security breaches and things, but they shouldn't be regulated, because the whole reason why we came up with this thing was to avoid regulation. So I think it's inevitable that we'll see more change happening.
Well, it's a very good point that you raised, because I think that's something that, again, was spoken about earlier on today, which is, you know, just because you've added a new technological layer doesn't mean you've actually changed the nature of the product. And the technology is phenomenal. But I mean, we've had some pretty amazing technology with high frequency trading. It doesn't mean we've actually changed the nature of the products that we're trading. In fact, we've probably made them more complex sometimes.
That's right. I think the current chair of IOSCO said, all these new products coming out, we're going to look at the structure to work out whether we're going to regulate it. So if it looks and smells like a derivative, we're going to regulate it like it's a derivative. And so there's a whole lot of regulation in Australia that came out in March for the over-the-counter retail derivatives sector to minimize leverage. You can only leverage a derivatives trade if you're a retail client, like 1 to 20, for example, is one of the restrictions. So if you put down $1, you can only leverage it on a ratio of 1 to 20. But with some of these DeFi products, you know, your teenage son in the basement could start doing that without really understanding the consequences using some of these DeFi products. So, I mean, they're amazing products. You can basically replicate the full banking ecosystem with them, and they have a place, a big place in society, I think. But yeah, they're just really fast cars that you don't need a license to drive at the moment.
It's an interesting point. If it's just a really fast car, shouldn't it just be a car?
Well, that's what the regulators are saying, but we haven't seen any like a lot of the jurisdictions. I think we were talking about this report before, Hannah. Only half of the 32 odd jurisdictions that said to FATF that they're implementing these requirements, only half have actually implemented some of these requirements, and then half have actually taken regulatory action. So it's still it's just early days, right?
Yeah, of course it is. Byron, I think.
Yeah, I wanted to just make a note on that. From an exchange perspective, or even from a personal perspective, I would just ask the regulators when regulation does come, because people do want it. We want customers to be safe. We don't try to fit a square peg into a round hole. So we don't try take a stable coin, which, or a Bitcoin, for example, the basic, we don't try call that a security. It's not a security. It's a new asset. It was created in 2008, 2009. It needs to be regulated as a new asset. I think thought needs to be given to it. And same with DeFi. I don't think we should classify and classify things as something that's existed in the past. Tongue in cheek, somebody today from a big bank said that they don't see the asset or the asset in the class of Bitcoin. In terms of if the regulation does come in, and there is strong and heavy regulation, that the worry is that startups, small businesses that have 1,000, 10,000, 20,000 customers, they can't afford to play with the big players, and the big four banks take over and it becomes their world, and the little guy gets kicked to the curb. So like Paul mentioned, it's a fine balance between regulating to keep people safe and ensuring that businesses can still thrive and survive. And I think we've seen Mt. Gox, and we've seen all the calamities of the crypto market in the past, but we are seeing self-regulation. We're seeing increased safety and security procedures and We seeing billions and billions and billions of dollars trading and transacting, and it's been done in a safe way without regulation. So I think that exchanges can learn from regulators and regulators can learn from exchanges and then come together and create something, some sort of international standard.
Yeah, I mean, that whole point of regulating something as something else, well, you shouldn't be regulating something as something it is not. But what we're seeing, I mean, even when you look at the definition of digital currency under the AML-CTF Act, the idea is that that goes to that particular type of asset. Similarly, if you're looking at other assets which have all of the bells and whistles of a derivative, well, it's probably a derivative too, because that's what it is. And then kind of the regulation flows from what that thing is, as opposed to saying, well, we need to regulate, so therefore we're just going to regulate it and put it in this bucket. That's the theory behind it. But I want to go back to Tess, because you mentioned something in this line vein earlier on where you said we're looking at making sure we have the right amount of regulation. So how do we go about that?
I'm so glad you asked. So as a regulator and as a supervisor, it's going to be quite the generic response. We take a risk-based approach. We take all of the information available to us and we take the data and speak to our partner agencies and other countries and then form prioritization and decide an approach on how to engage with the exchanges in this case or anybody else in that space. There's nothing overly fancy about it. We're in the space of firstly working with exchanges to uplift capability, and where that fails, then we look at what actions and powers we have available to us to gather enough information to then move forward in whatever the appropriate direction is. But in terms of how we decide it, when you're looking at 470, it's a large number, and we are still only humans working through that and looking over that data and that information and making informed decisions.
It's quite interesting when you end up with a new type of or entity, a new type of business. How have you actually found working with people in this space compared to, say, a more traditional area like remitters, for instance?
I approach the space as I do every other sector. I look to understand the business. I ask enough questions and request information and documentation. And if there's anything that doesn't make sense, we ask the question. I would be inappropriate to make decisions without understanding first.
I mean, obviously, there are some differences in who's operating these types of businesses. So just an anecdotal observation of my own, I think I've never seen, well, from in where I sit, I don't see a lot of questions coming up from digital currency exchanges about the use of digital or electronic identity verification, for example. Whereas when the pandemic hit last year and face-to-face verification, document-based verification became challenging for those who were relying on it, there was a number of sectors where it became a significant question for them about how do they do verification if they can't meet the customer. So obviously that wasn't such an issue in the digital currency exchange space because of the tech-savvy nature of the people running the businesses. So.
Yeah, when we're talking about this space, you do have that additional area, which is the technology, and you can kind of see that there are learnings from perhaps this industry that might be implemented elsewhere. I think moving on slightly when we're talking about this industry versus others, obviously a lot of the time we're seeing this sort of regime come from an international accord with FATF, or you're finding that people have to, from an implementation perspective, comply with requirements before they hit Australia. Where do you see that going as a global trend? Do you see this kind of happening across all different areas? I mean, obviously with exchanges, Paul, you've kind of brought that up.
Well, I mean, the travel rule is, I guess, the main one which could have implications across borders, because that's the way in which digital currency exchanges in Australia will deal with their overseas counterparts and vice versa. So that will require the counterpart due diligence both ways, and the state of a country's regulation of a sector may be taken into account in assessing the risks of dealing with a digital currency exchange in that jurisdiction. So that's certainly the equivalent. The equivalent happens in other more traditional financial sectors. where there's a number of arrangements and a number of requirements to consider the state of regulation in the other country and the extent to which effective supervision is happening as part of a risk assessment of dealing with an entity in that jurisdiction. So, and I think that's going, but for DCs, off the top of my head, I think probably the travel rules where that's going to be the most obvious case where the global nature of the standards could have an impact.
Yeah, it's interesting, having worked on a few of these projects internationally, we see people come to us with the jurisdictional survey, which says, can you please tell us all the potential laws that apply? And we can see they've gone to about 7 or 8 different jurisdictions around the world with the same question, some of which work in different jurisdictions and others don't. But the idea is they're saying, okay, well, we need to know what our obligations are. What's really funny is they look very similar to the same jurisdictional surveys that we'll get from any other financial services company. So that level of education and prudency with the way that these organizations approach their businesses has certainly changed over time. But Byron, you were mentioning before that kind of having worked in Malaysia and with the requirements there for the exchange, that's quite a different regime to, say, Singapore or Australia.
Yeah, so I'm not an expert on the Malaysian regulation. However, we were discussing, as an example, if XRP in America, the SEC finds that it's a security, and the Malaysian government also find that it's a security, our license allows us to trade XRP because the regulation there allows for, I'm not sure the exact word or name of it, but security tokens. So we're allowed that in Malaysia. We're allowed initial exchange offerings in Malaysia. So they haven't gone, and again, don't quote me because I'm not an expert, but they've created regulation specifically for the asset class. So we know crypto at the moment is not a financial product. We know it's something financial. We know you buy it and it can be sent like money and used like money, and you can buy Tesla with it, but it's not a financial product. And it's a big industry, and it's something that thought needs to be put in to create some sort of regulation that still allows for businesses to grow and flourish. So CipherTrace, all these transaction monitoring companies, they weren't created because of regulation. There was a problem, they created a solution, and now people are using them. That's self-regulation. So I think that government can work with these businesses and work within the industry to really create regulation. It's maybe similar to Malaysia, but again, grateful that the Australian government has held back and taken a wait and see approach, because they can see what's worked in the best jurisdictions and pick and choose what works.
Yeah, so I mean, it's quite an interesting approach, because you say, you know, crypto, effectively a crypto asset is an asset. The question is, of course, what particular type of asset is it? And there are some which probably do fall under the definition of a financial product, and then you're probably into Chapter 7 of the Corporations Act and all of those sorts of licensing obligations. But realistically, what you're actually coming down to is the base behind that is the principle of keeping consumers safe. And if that's what you're trying to do, well, you can probably do that. There are certainly regulatory regimes there, which if you fall under that bucket, you've got to comply with. But what you're also talking about is, even if you don't fall under that regulatory or legal bucket, you've actually got a broader obligation to try and comply. And it's interesting you're talking about using technology to comply. So are there any other technologies that you're seeing? So obviously tracing, what other technologies are people implementing to try and almost comply with this self-regulatory regime?
Sure, I guess. Well, just to go to your first point, that it's about keeping customers safe. I think there's that, and there's also obviously your guys' job, which is making sure that terrorists aren't funded or financed by people, by your customers, and to try and really diminish terrorism through financial means. That's quite a big thing. Still on. Yeah, I think that's quite important, and keeping customers safe. So there's two broad brackets that you kind of need to think in. In terms of technology, I'm trying to think of other protocols and things that we use internally. Do you want to?
I'll jump in and just
go for it.
Say they're not necessarily for self-regulation, but there are a lot of tech companies looking to assist with meeting regulatory obligations. So transaction monitoring, your customer identification. Evan mentioned electronic verification. So there's a lot of those technical solutions that are being created in the space, knowing that digital currency exchanges are not in the core business of AML/CTF. They're just meeting their regulations to carry on their business. That helps.
Yeah, I mean, it's one of the other things that I have noticed is this concept of custody in this world. And custody is not necessarily, you go out and get an AFSL and you're providing a custodial depository service if the asset isn't a financial product, because that's not really the bucket you end up into. But I mean, most people say, I've got to do something to make sure I'm holding these assets, and I've got to make sure I'm doing something to make sure I'm holding them appropriately. And actually, it's a technological part of that too.
And from a customer perspective, you want to know that the assets are with your exchange and they haven't been sent off to Bolivia. And if you're holding a stable coin like USDC, which do audits on a regular basis, you want to make sure that those audits come out on time and they've got the exact amount of dollars that they've minted. And you want to make sure that your USDC is actually worth a US dollar. So yeah, there's still technologies that need to be created for that sort of pass-through of information to help customers and better customers. But yeah.
Yeah. So I think we're almost at time. So I'm just going to go down the line because, of course, this is about global trends. I'm going to ask each panelist, what do you see as the biggest trend in regulation that's going to come up in the next year to 2 years?
Look, I think regulation needs to cover 3 spheres: sort of legal compliance, like code of conduct sort of stuff, financial adequacy, and technology security. And so I'd like to think within that time frame, there are standards that are required, externally audited standards that are required across those 3 areas. There already are standards like that for, say, the highly regulated sectors, like banks and custodians and things. And so I agree, it needs to be like fit for purpose. It needs to be fit for the unique aspects of what's going on here. But I think those 3 areas probably need to be covered in some way, particularly if Australia wants to keep being a leader in having, a high standard. The cost of business here is a bit higher, but you should get better security, better, higher degrees of trust. That's the intention, at least, of regulation. So I'd like to see it sort of progressively, pragmatically move in that direction, with the industry being consulted collaboratively. And can I just say, AUSTRAC is very good. You guys are always willing to jump on a panel. You're always willing to answer a question. And I think that's partly cultural to do with AUSTRAC, but it's also in the act. I think you actually can help people and give advice, whereas other regulators like ASIC in the Corporations Act, they can't give legal advice. They don't have some of the same liberties. So it's worth knowing that, trying to navigate the environment in Australia. But I hope that that friendliness and that collaborative approach continues, because I think it's really good.
Byron?
Okay, so I think that obviously the FATF regulations will be implemented most likely, in my opinion, sooner than any sort of asset regulation, whether that's done by ASIC or not, unless something bad happens. I think if something bad happens to a lot of customers in hundreds of millions or billions within Australia, then the counter will happen first. Then I think regulation will come in fast and hard. But opinions are my own.
Of course, everyone's opinions here are their own and there's no legal advice.
Yes. I guess my global trend is hopeful in that we would look at how regulators and different jurisdictions all work together in solving problems. Mostly, I think I saw on the screen earlier someone asking about scams and fraud and Ponzi schemes. I would like to see some regulation coming down in assisting customers and businesses in dealing with that. But Evan probably has something much more exciting.
Look, I was just going to say that, yeah, of course, the FATF standards, as they've been revised, set out a range of work that needs to be done around the world, as well as in Australia. But I think setting that aside, probably one thing that will continue to happen as the industry matures is both at the financial intelligence unit and regulator level and in industry, an evolving understanding of the risks, the money laundering, terrorism financing risks of these virtual assets, and growing that sophistication so that we can make our regulation and our efforts and our work more targeted and more effective and up to date as things evolve. I think that would be the ideal that we could hope for.
I think you all raise really interesting points about that sort of global collaboration and how we're seeing that it's not just happening in Australia, it's happening overseas with this broader regulatory sort of conversation, which then gets implemented in a way that meets each jurisdiction's own requirements, but then of course needs to be interoperable, not technologically, but from a legal perspective. But thank you all so much. It's been a wonderful conversation. Evan, Tess, Byron, Paul, thank you.